Hi everyone, welcome to the WealthAbility Live. And today we have a special guest, which is one of our favorite guests for our show.
Thank you.
In a bit I will ask him to introduce him again in case you are new here. And if you're watching the replay, welcome the replay viewers. So make sure you be free to comment if you have any questions, and even if you're watching replay. So let's stay interactive, and I will be able to acknowledge your questions and get back to you. Okay, so today we are talking about the basics of inheritance tax planning. This kind of tax, of course, we come across a lot of like income tax.
Yep.
Some of you have capital gains tax, and inheritance tax is another capital tax, which is not, people think it's not very common, but it's very important to be aware of basic things. So today I think it's worth bringing this topic to the table, and some of you might start to think about it. So today we have our guest, and who will talk about, share more insights on this topic. So Aidan, before we jump into the main topic, just introduce a little bit about yourself, and in the meantime, I will have my laptop here. I will invite some people so that more people can watch our live. So off you go.
Thank you, Hannah. Just very brief introduction. My name is Aidan Dow. I run Aidan Dow Wealth Management, and I help individuals with all aspects of investing and financial planning. And inheritance tax is a key thing that I'm involved with, and helping a number of clients with some of the aspects of inheritance tax planning.
Yeah. Okay, good. So perhaps you can also talk about, of course, before we have invite you on other like financial planning and other like retirement planning.
Yes.
So it's more something that is more ahead. So, of course, some people might know a little bit about inheritance tax, or some people doesn't. Just perhaps you can share when people need to think about these things.
Yeah, I mean, just very quickly, inheritance tax is basically the tax you pay on all your wealth when you come to die. Now, technically, it's not your problem because you'll be dead.
Yeah.
But it's very worthwhile considering and making early plans for it, because if it's one of the taxes is actually through good planning, it's actually you are able to mitigate a huge amount of it if you are able to plan and think about it going forward.
Yeah, absolutely. Yeah. So as we mentioned, inheritance tax is another capital tax.
That's right.
So it's like capital gain, you pay tax on the profit you made when you sell the property. Yeah. And inheritance tax is tax on the estate. Yeah. So perhaps you can talk a little bit about what's included in the estate. Perhaps something is included and something is not.
Yeah. So your estate is basically everything that you own on the day that you die. So that can be your properties, that can be your investments, ISAs, cash in the bank, all these things, your car, all these things come into your estate effectively. So what would happen is on the date of your death, you'd look at all the assets that you own, you add them all together, and then that is effectively your estate. And potentially there is a tax to pay on that, depending on your circumstances.
That's absolutely right. So unfortunately, everyone, there are two things they are unavoidable. One is death. The other one is tax. So unfortunately, when you die, these are the things we need to think about, and the taxman, when these things happen, they are after you. They want a portion of this. Yeah.
Well, look, it's a very stressful time for family members, and one of the things about inheritance tax, it's due within a certain period of death, and it can be a very stressful time dealing with death and things like that. Anyway, and having to deal with the problem of raising the funds to pay the tax can be very stressful. Things like properties may have to be sold, and that can be a very, very stressful time. So if without any planning, it can put a lot of upset into what can be a very stressful time.
Yeah, absolutely. Yeah, it's planning is very important. And part of the planning, because a lot of people heard about the importance of having a will.
Yes.
So of course it's like there will be the difference, like having a will and without a will.
Yeah.
So what would be the consequence when someone died without a will?
Yeah. Well, let me just say before we talk about the will, just to understand the tax. You take the value of your estate, and effectively you have to pay 40% tax on that, minus what's called your nil rate band, which is the first £325,000 of your estate is inheritance tax free.
Yeah.
Then anything above that would be taxed at 40%. So let's just take a very straightforward example. If somebody had an estate, you took up all the assets, add them together, they were worth 500,000. The first 325,000 would be no tax at all, no inheritance tax to pay on it. The next tranche up to the 500, the 175,000, would be taxed at 40%. So that's a significant amount of money, 40% of £175,000. So yeah, that's the basics of it. So if we understand that, we can understand the next question of why it's so important to have a will. If you don't have a will, then what can potentially happen is that the people that you don't want to inherit your money could inherit your money, which is never nice. Potentially, the people that you do want to inherit your money won't inherit your money. It means if you haven't made a will, it means that the state may actually get all your asset, which maybe is not what you want. So there's it's vital really that you make a will, and there's a huge percentage of the population haven't. Something like only 40% of the population have. So it's a really, really important issue. If you think you don't have a will, then you're risking your wealth going to either the government or people that you don't want, or more importantly, it's not going to the people that you do want. So with a will, you can direct your wealth to exactly who you want it to go to. And you can plan well so that you're mitigating the tax as and when that happens. But it's a really crucial thing.
Yeah, absolutely. Yeah. Because hi Glenn, thank you for the like. So so as you mentioned, the inheritance tax. Of course, later on, if you are on our mailing list, we'll send out the numbers in the newsletter. So there are a lot of numbers we talk about. So 325,000.
Yep.
That is the new rate band.
Yep.
And anything above that, that's 40%.
Yeah.
So in like just we imagine someone's estate, it can be like easily six figures.
Easily, I think. People owning a property, especially down in the south, that just by owning a property alone will take you above the nil rate band. And the nil rate band, sort of technical term, is just the amount of your estate you don't pay tax on. Yeah. Yeah.
Yeah, absolutely. Yeah. And 40%, it can be a lot of money.
Significant. It's a significant amount of wealth.
Significant amount. And also, as you mentioned, by having a will, it can actually help you. It's not guaranteed, but it can actually help you to, having your estate to the right person.
Correct.
Like the person you want.
Yeah.
Not the government or not the people you don't want. Yeah.
Very, very important point. So it's worth just expanding on that. If you do have a will, and if you're married, many people are married. What happens is, if you are married and either the husband or the wife passes away, then all the assets of the estate move across to the surviving spouse. So that's good. There's no inheritance tax at that stage. Everything. Let's just imagine I was married to you. I died. Everything would pass across to you. Now, that's actually very good because there's no inheritance tax at that stage. But what it's not good for is actually not used my nil rate band, my £325,000. So what it's done, it's made your estate much bigger, and it's meant that if anything happens to you, the inheritance tax on your death will be significant. So what many people do when they're setting up a simple will is to set up a nil rate band trust, which means when I die, if I'm married, then my first £325,000 goes into a trust, and then the rest would pass across to you. So that's a very straightforward thing to do, but it's a very important thing to do because it saves significant tax, inheritance tax, and it's it's a way of using an allowance which you're given by the government, and many people don't have that in place, and it's a key thing. If you're married, it's absolutely vital that you've really got that in place to save on a significant amount of tax.
Yeah, absolutely. It's actually very, it's also down to the planning, and also very simple tweak.
Very simple, straightforward.
Very straightforward tweak. And then you can save, I think, 325,000. That's about 130, roughly that amount of tax. So that is it's a big amount.
Yeah.
So just imagine.
Yeah. There's amount of planning involved. There's a cost involved of setting up that, but it's reasonably straightforward.
Yeah.
But you look. One very straightforward thing to do: set up the nil rate band trust and potentially save 130 odd £1,000 of inheritance tax.
Yeah, absolutely.
Yeah.
And also, in earlier conversation, we mentioned inheritance tax is actually can be very easily avoided legally. And there are like simple tweaks like this. Of course, there are also some simple tweaks. Well, there are different strategies, like simple ones, basic ones, as well as advanced ones. So today we're not going to go to too much advanced. So we just talk about some simple ones that, like things people can do during the lifetime. Things like if you give a gift or when you give a gift, it can be exempt from the inheritance tax.
Yes. Yeah. So obviously, as you're getting older, you realise that you may have more wealth than you need for your life, which is a good position to be in. Yeah. So what you can do is you can gift assets away to your children or your family members. Now what would happen is if I gifted money across to my children, then effectively that would be called a potentially exempt transfer. So it's a gift, but the technical term is a potentially exempt transfer. So basically, if I survived a further 7 years, then the gift that I'd given would be outside of my estate. So that's why it's called a potentially exempt transfer. It's not exempt the day you give it, but if I make the gift, survive another 7 years, that would be outside of my estate. It starts to the amount of tax on it starts to trim after 3 or 4 years, but it's worth noting that's what a potentially exempt transfer is. So you can gift money or investments away; they actually stay in your estate even though you're not holding them, looking after them for 7 years, and then after 7 years they do drop out, and that's to avoid people transferring all their assets away from them like 2 or 3 days before they die, and then not have an inheritance tax bill to pay. So it's a very fine balance act of making sure that you've got enough money to look after yourself and live the lifestyle you want in retirement, and actually getting assets away from you to the people that you want to inherit. It's a tricky thing. It's a very tricky thing. Yeah,
absolutely. Because there's a like 7-year rule. Yes, of course, it's tapered down each year.
That's right.
But then it's always worth noting that it's the earlier you planning, the better. Yeah. And also, I suppose like very simple thing people can do is they can start giving away, give a small amount. That's right. Regularly.
Yes, there's also things like small gifts. So you can give away small amounts. I think it's £250 each year this year to on an annual basis without that being a potentially exempt transfer. There's gifts on marriage. If your children get married or people get married, you're allowed to gift them money without being part of the potentially exempt. Yeah. Other things like gifts to charities and political parties can instantly come outside of your estate. So there's lots of things that you can do. But I think the key thing is understanding that that rule that it stays in your estate for 7 years if you're gifting assets away. There are some other things that are more technical, more advanced, but I think if you understand the basics of the nil rate band, the importance of a will, and understand how gifting works and how you can get caught by that potentially exempt transfer 7-year rule, that's really the basics of inheritance tax. And I think that's the key things today.
Yeah, absolutely. And also just following, you mentioned the charitable donation.
Yes.
Because if you give certain amounts out of your estate to the charity, you actually pay inheritance tax at 36%.
Right.
You would pay a lower rate rather than 40%. So that one you can also think about taking advantage of. Yeah. So yes, these are the basics. Of course, there are some more practical and more advanced ones. Perhaps, of course, we will have another session to cover all the details about advanced strategies. And I think these are the things, like these videos is more for educational purpose, for raising awareness. But of course, these are not a replacement of a professional advice. So perhaps, Aidan, you can just mention a little bit about, what can be the advanced strategies. So,
the advanced strategies, similar to the sort of nil rate band trust, you can go on to set up more trusts. Trusts have been around since the days of the Crusade.
Yeah.
That's basically people putting money in effectively a safety deposit box.
Yeah.
For their the people they want to access when they're no longer around. So you can use them depending on the type of the situation, and obviously there's a cost involved with setting them up. That's one thing, and also holding assets. Certain types of assets are have a bit more flexible on the nil rate, on the potentially exempt transfer. So it's what you call business taper relief. If you hold business assets, they can drop out of your estate within 2 years, as opposed to waiting for the 7 years. So that's things like AIM shares and business assets. The nice thing about that is you can still control the assets, benefit from the income of the assets, but after 2 years they fall outside your estate. So a lot of people with a risk tolerance for that can like them, but that's a more advanced side of it. So the trusts and business property relief are two things that we can maybe talk about in more detail another time.
Yeah, absolutely. Yeah. So I think we covered pretty much today on the basics. Of course, as Aidan has mentioned, like all these trusts and the business property relief we can cover in a separate session. So is there anything else outside what we've discussed about basics that people absolutely need to be aware of? Apart from what we've discussed, is there any further comments?
Well, I think the key thing is to understand that inheritance tax is, it's chunky. 40% of most of your assets is very chunky.
Yeah.
It's one of those things that you get that with good planning, you can very much mitigate a good majority of it. It's never nice to think about what's going to happen to you or moving on and dying, but that's always a good reminder of making sure you live the day and seize the day. So that's something. But the nil rate band, it's worth understanding that. So it's worth understanding if you are married that you can to set things up so that you're not wasting your nil rate band if you die before your wife or vice versa. And then it's just really good to understand that those gifting, how things will stay inside your estate for 7 years. But that's the key things. That's the key simple things to understand about inheritance tax, and the earlier you think about it and start planning for it, the better.
Yeah, absolutely. So it's always down to the planning, and I think the purpose of our video is really to raise the awareness. So if you haven't thought about it and you suddenly realize it's time for you to consider this, and then make sure you do reach out to Aidan. So finally, of course, we mentioned these are for educational purpose, and Aidan does the tailored professional advice for relevant topic. So just can you tell the audience, like, if anyone would be interested in finding more about this, so what would be the best way to connect with you? Yeah,
the best way is I'm connected to you through Facebook.
Yeah.
You can come on my website, aidandowwealthmanagement.com.
Yeah.
Or on email me on aidan@aidanwealth.com. So there's plenty of ways to get in touch with me.
Yeah, absolutely. And also, by the way, Aidan is also in my private Facebook group, which is called Tax Deductible Lifestyle Tribe. The link is in the description. If you are interested in connecting with myself and Aidan, make sure you do join the group. And also, more importantly, is that we will send out all the numbers. We talk about a little bit numbers.
Yeah.
We'll send out a newsletter by the numbers, by the figures later on. So if you want to be a part of the mailing list and be receiving the numbers, make sure you do join the group and insert your email address. So make sure we send our emails to you. Okay, so thank you very much, Aidan.
No, thanks, Hannah. It's been good fun.
Thank you, and hope you enjoy this one. If you find this one useful, make sure you do share this video out so that more people will, it's more for awareness, and make sure more people will be aware and really, really leave the legacy that's the way they want. Okay, so thank you very much. Thank you for watching and hope to see you very soon.
Thank you.
Bye.
Goodbye. Thanks.